In this third video, we're going to talk about expectancy, money management, and then apply it to decision making. So before we get started, let's do a very quick review of expectancy. Here's the spreadsheet we talked about in the first video, and you can see we have some different settings in here. Remember, you can change this to 7 and 3. There we go. And that'll change the numbers. And if you remember, what we were trying to do here with expectancy was to figure out what this was going to do over the long haul. Okay, this is 100 trades or 200 trades or even 1,000 trades. We want to know, what is the system going to do? You see, too often we get caught up in the trade that's right in front of our face. And we get so caught up and so focused on that we lose sight of the fact that while this trade and the next one and the next one and the next one might be losing trades, that doesn't take away from the fact that the system over time makes money. What we're going to talk about here is a way to look at expectancy to help us in our decision making. You see, sometimes I think as traders, we are looking at a potential trade and we haven't really considered what the long-term effect is going to be, which makes it even harder to get past this kind of short-term thinking. So what we're going to do is take a look at expectancy first. And we're just going to run through some exercises, but we're going to do it in the context of the markets. So let's go ahead and move this aside. And you can see here that I've got some blue lines on the chart here. And in this example, what we're going to do is pretend that we've been watching the market, and we've seen the market make this high, and then this low, and then this high, and then this low. Now at this point, what we can now decide is that the market is trading inside of this little trading lane here. And if you will recall from the daily video yesterday, that the market was trading up near the top end of the trading lane that's been going on for most of 2007. So we could decide, for whatever reason, we're thinking to ourselves, okay, I want to go short. And I can see that the market is making this trading lane. It's trading up near the daily high. I think that this is going to be a good place to enter in. But I'm not really sure if I should take the trade because every other trend is up, long-term, short-term, mid-term. They're all pointing up. So I'm going to be going counter-trend on this trade. Okay, so let's break this down into pieces. Well, first of all, let's take a look at the expectancy. And since we really don't know what the percentage win is going to be on this single trade setup, let's take a look at some of the worst case scenarios. All right? Let's look at putting on 10 lots, okay, whether this is 10 minis or 10 regulars or 10 micros, it doesn't matter. Let's just look at this in terms of lots, okay? So we're going to put on 10 lots. We're going to risk 35 pips. We're going to make 25 pips on our first set of 7, and we're going to hope to make 78 on our second lot of 3. Now, again, we can't just focus on this one trade, can we? What we have to ask ourselves, what happens if we take a bunch of these counter-trend trades over time? Well, we can see that if 40% of them win, then we're going to lose money over time. If half of them win, we're going to make some money, but not a lot. For every dollar we put in, we're going to make 7 cents. And if we can get up to 55 or 60%, then you know what? This is actually some really good money in terms of overall trading systems, making a quarter in profit for every dollar that we put in. So when you put in $1, you get out $1.25. That is actually a very good system.